Welcome to the final exam prep videos for the financial accounting prep exam. Question number 1 is all about bonds and bonds payable. We're a new company, we've started, we want to issue some debt so that we can get money from people. So we're going to put these instruments called bonds out there for people to buy. A typical example might be a $10,000 bond. Somebody will give me $10,000. In 5 years from now, I'll have to give them that $10,000 back, but it gives me some cash now to get my business going. I will also, because of the percentages on the bonds, give them interest every year. So if it's 10% interest each year until I finally pay them off in that 5th year. Percentages vary, and that's why there's a little trick to bonds payable that we'll go over in a second. So in our case, we've got a $2 million bond that we're going to issue. So there's probably several bonds out there. They total $2 million. Many investors are involved. It's a 10% bond that in 5 years from now we're going to pay it all off, but we sold it at 98. And if you remember from our classroom discussion, 98 is not 100%. So we did not sell it for $2 million. Must be the bond rates out there are higher, and we had a lower one, so people wanted to pay us less for it. So the $2 million, even though we're still going to owe $2 million, we only received 98% of that money, or $1,960,000. So cash came in $1,960,000, but in 5 years, we still got to record the fact that we're going to owe $2 million to those investors or those debt holders. And that's a liability account called bonds payable. Liabilities are on our balance sheet, so it's going to show for that entire 5 years that we owe that $2 million. But we got a difference here. That difference is $40,000 because our debits have to equal our credits. What is that $40,000? We call that discount on bond payable. Discount on bond payable is a contra liability that keeps track of the amount of essentially interest that we're having as a difference between the $2 million and the $1,960,000, because we're going to give them that whole amount back and we only received $1.9 million, so it's almost like a form of interest. But the discount we're going to reduce every year for the 5 years until it's completely gone. The second scenario that I could have put on the exam is I could have made this 101. So let's say we're in an environment where the interest rates are normally lower than 10%. So that 101, we would multiply 1.01 times our 2 million, and we get 2,020,000. In that case, we would have got more money because people really wanted our bonds because the percent was higher than everybody else's bonds, so they were willing to pay us a little bit more. So that's called premium on bonds payable. It's treated just like the discount. It is a form of liability, kind of acts like an extra bit of interest revenue. But every year we'll reduce that just like we almost depreciate it or amortize it until it's down to zero when we pay that final $2 million off to our employee or to our people, bondholders that only paid us $2 million, but we got $2,020,000 from them in the premium situation. That's the answers, possible answers, for question number 1 on the final exam prep.